Let's take a look at the market action after the first week of trading via a few indicators, starting with just a 20-day moving average here in red. And as we know, just looking at this action over the last 2 years, market tends to trend, and when it does, it tends to either stay below this short-term trend indicator or the 20-day moving average or stay above it. And we saw that for weeks and months at a time in both directions, again, 2022, 2023. Now, the other part of this, of course, is that we've seen pretty substantial declines occur after the market has undercut the 20-day moving average after spending a good amount of time above it. And that's what we're dealing with potentially right now. We saw a bounce yesterday on Monday with the big advance, but still testing it. And just going back over the last few instances, we can see just how big those declines were, even in 2023, where it happened, in February as things were rolling over again, and even more so back from beginning of August to, again, the October lows, right? And so that's what we're dealing with now. And considering that we're up about 17% from the low in just about 9 weeks, I don't think anyone would be surprised to see a similar type event occur now, where we have had a little bit more of a drawdown recently, not too big still, but nothing as substantial as we had, even the prior 2 times in 2023. But, there are other instances we can look to in the past to show what happened when the market dipped below the 20-day when it was still in a long-term uptrend. And one of the things we can look at, again, is what just happened over the last number of months. The market was able to hold twice the 20-day in June and early July before rolling over. That's what it's trying to do again now. So potentially this could still go higher. Now, again, it doesn't seem likely, but looking back to 2020, 21, we can see that of all the times that the S&P undercut the line, only twice did lead to substantial downside action right away. And that was just twice in September and October of 2020. As we know, the market was down 10% each time, eventually recovered. But again, this was, pretty severe, pretty swift downturn in a short period of time, both times. Every other time, however, right, what happened? Undercut the line, marked a buying opportunity, and that uptrend, well, of course, lasted all the way up until the end of 2021. And so another way to frame this, of course, is looking at the Bollinger Bands. And as we know, the middle line is the 20-day moving average, with the upper line and lower line being 2 standard deviations away from it. And as we know, the epitome of an uptrend is seeing the S&P, or for any security for that matter, oscillate between the upper line and the 20-day. We saw it just recently. We saw it from the spring and summer as well, with the opposite being the case on the way down during the corrective period from August to October. And again, looking at this in 2020, 21, the times when the S&P undercut the 20-day and hit the lower band, most of the time, those are very short visits and marked really clear buying opportunities every single time, all the way up to the end of the year. The only time that really wasn't the case was during the pullback from September for a few months, and then finally getting the rally again toward the end of the year. So, the market has started to rally. Of course, it's been up since the October 2022 low, but along the way, we have had some volatility up to this point, where now, after the most recent low, of course, the next phase of this could be something like this, right? And that's what we're continuing to look at as we go along here. And so also, coming off the first 1% advance of the year, and the biggest advance we've had since December 21st. Now, going back since the beginning of the move in October, this is now the 8th 1% advance over that time frame, but only the 3rd in the last 2 months, going back to the middle of November. So things have started to slow down from the explosiveness to start this, which we knew would be the case, and just seeing potentially intermittent 1% advances along the way is healthy, for lack of a better word. Now, the other part, of course, is that there's only been one 1% decline, right, here on December 20th, all along the way, spending 49 trading days, right? So this doesn't break any records, but it is similar to, again, the periods we've talked about before, where we've seen substantial rallies and consistent uptrends. And we go back to 2021, we can look to 19, 2017, 2013. We just know that when the market tends to trend higher below two-way volatility, there's just a lot fewer 1% declines and also 1% advances, right? So that's what we look for. Again, continuing to look for as things progress. Now, from a pattern perspective, just over the last few weeks, some short-term activity to keep in mind. We have a potential bullish pattern here. This is basically just a continuation pattern, maybe. If we can break out to new highs, this would obviously target higher from here. But at the same time, we have to see what the market does with this bounce, because if it fails, right, to make a higher high, we'll have a lower high as a result, and this could just confirm or complete this topping pattern. This is just a small bearish head and shoulders pattern. And if this did break lower, a lot of ifs, but we know how this goes, that would target around the 4,600 zone. Still not a big deal, but we haven't had a successful bearish pattern where one gets completed and has a downside target hit, right, since around here. So if that 4,600 level gets hit, the good news is that it would still be above the breakout zone that we had from December, which would keep this 5,030 upside target in play. So that's a setup right now at the beginning of January. We'll be keeping everyone updated along the way. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.